Great. Um, so I will start my session. So good afternoon, everyone.
Pratyusha, can I hold
Uh,
you for a second?
yeah,
I can see only 4 people here. Do we have enough participants? The question, we can wait
I,
for 5 minutes in case if people are still joining.
sure. We'll
So
do
the
that. We can.
participants will join on another link. The live link is there. The participants have already joined on that link. This is for our Zoom link for speakers.
Okay. All right, Gujan, sure.
Okay.
Thank you.
Okay. So, Naveen sir, can I start this session? Like, do you want me to
Yes,
give the
Pratyusha.
introduction?
Yes,
Okay.
we can get started.
Okay, great. So, good afternoon, everyone. Warm welcome to the 10th session of the ICI Global Udan webinar series. My name is Lakshmi Pratyusha, and today I'm honored to serve as your moderator for today's session on unlocking US GAAP, insights into the financial statements preparation. So first, as many of you know, US GAAP is the backbone of the financial reporting in the United States and influences many global practices today that we have across on the financial statements preparation. So for Indian professionals and organizations, understanding US GAAP is more than a compliance exercise. It is a opportunity for many of the CA firms that we have today. It is a skill that is actually required that will open doors for the international markets. So in today's session, we'll understand how US GAAP is used to prepare the financial statements preparation. So it is useful for the Indian professionals who wants to, extend their expertise on the global stage and also not only just advise the clients, but also understand the preparation for the US subsidiaries or utilize them in any of their practice areas. So we are privileged today to have CA Naveen Agarwal ji, our eminent speaker for today. CA Agarwal ji is a chartered accountant and a certified public accountant from USA, with over 2 decades experience in many multinational corporations like Tesco, HSBC, and Broadridge Financial Solutions. So his expertise covers financial planning, US GAAP preparation of financial statements, and financial solutions, IFRS reporting. And he's also an educator, having taught many sessions for the ICAI professionals in UK and USA. So today, in over the next 2 hours, what we can expect is Mr. Naveen Agarwal taking us through how to prepare the financial statements as per the US GAAP. Then we'll go through a panel discussion and a question and answer sessions where all the participants can put down their questions in the chat. So what we'll do is once Mr. Naveen concludes his sessions, then I'll collect all the question and answers, and then we can summarize it and we can discuss in the Q&A session so that there is no interruption for his session and his session is more fruitful and understandable. So with this, I will conclude the introduction and I'll hand over it to Mr. CA Naveen Agarwal. Thank you.
Thank you, Pratyusha, for that wonderful introduction. Hi all, good afternoon. Hope you all are doing good. So let's get started with today's webinar. The purpose is to introduce you to a few of the concepts and ideas of US GAAP reporting, as well as the preparation and presentation of financial statements as per US GAAP. So when we talk of US GAAP, there are various, similar to what we have in India, we have got various accounting standards. In US, we call it ASC, accounting standard codifications. So all the numbers that you see here, 205, 10, 210, 220, these are all the accounting standard codifications. So you can say these are all accounting standard numbers basically. So US GAAP is structured accordingly. So when we talk specifically of the preparation of financial statements, the topic of preparation of financial statement is covered across various accounting standards, starting from 205, which talks about preparation of financial statement. 210 is specific to balance sheet. 220 talks about income statements. 235 specifies the general requirements of notes to accounts. 885 talks about subsequent events, 275 risk and uncertainties, and 850 talks about related party discussion. So these are the accounting standards. In addition to accounting standards, we should also be aware of uh, regulation SX. Basically, this is a SEC regulation. If you don't know, SEC is the Securities Exchange Commission. This is more like SEBI in India. So this regulates all the listed companies, and all the listed companies have to file their annual reports along with financial statements with SEC every year as well as every quarterly interim financial statements. So while US GAAP is very exhaustive, very prescriptive for preparation of financial statement, the SEC regulation SX is also equally exhaustive and equally uh, prescriptive, specifically applicable for the listed companies in US, as well as the foreign companies for foreign private issuers who are raising funds in US markets. So in case any of your clients are listed companies or any of your clients are foreign issuers in US, or if any of your clients have raised ADRs, we should be strictly adhering to SEC regulations, because if there is a conflict between GAAP and a regulation will always prevail. But for your information, so far, US GAAP and SEC regulation are in sync. There are no conflicts. Both are pretty much in sync. But there are few additional prescriptions or additional requirements mentioned by SEC regulations. So all listed companies have to follow that regulations. While GAAP is slightly flexible, regulations are this. So GAAP is basically principle, whereas regulations are rules. So you have to follow the rules. Moving on, just to set a bit of a context and expectation from today's session, US GAAP covers a wide area of accounting and reporting. So we can actually split the applicability of US GAAP prior to preparation of trial balance and after trial balance. So we apply US GAAP in our day-to-day accounting right from the initial transaction recording. So US GAAP prescribes the criteria and conditions, how to recognize capex, when it should be capital work in progress, expense. So these are just few examples. I mean, there are recognition criteria in everything we do, right from day-to-day accounting, right from revenue or selling your goods, how do you recognize, accounting for discounts, everything on your day-to-day basis, how do you account, GAAP is applicable. And then the GAAP is applicable at the period end, whenever you are closing your books, either quarterly or annually, the GAAP is applicable, and then which is called a subsequent measurement. So the first part is like initial recognition and measurement. The second part is subsequent measurement. Like before you prepare a trial balance, you may have to close your books. So while closing the books, we may have to account for all accruals, deferrals, prepaids. We may have to account for all the depreciation as per US GAAPs. We may have to account or value our inventory as per the US GAAPs, and also the cost of goods sold. These are few examples, but we will see in subsequent slides. There are lot many examples that are applicable. And once our books are ready, we prepare the trial balance, and after preparation of the trial balance, we move on to preparing the financial statements. So when we prepare the financial statements, there are lot many accounting standards and accounting gaps applicable, uh, right from how to prepare your financial statement, what are the content of balance sheet, how income statement should be prepared, how do you account for your uh, changes in accounting policies, how do you account for subsequent events. Basically, subsequent events are the events occurring after the reporting date. So let's say if 31st December is your reporting date, and if fire happens on let's say 31st of January. So after the reporting date, but before the financial statements are issued, how do you account for that? And also some of the offsetting rules, do's and don'ts, what can be offset, what cannot be offset, we will see that. More importantly, we will focus on consolidation, because my experience, preparing a financial statement once you have a trial balance accounted as per US GAAP is not difficult. The challenges multiply the moment you have to start consolidation, and it even further intensify the moment you have to consolidate the financial statements of your subsidiaries in different jurisdiction or a regulatory environment. Let's say, for example, a US company want to consolidate a financial statements of an Indian company. So what are the challenges will face and practically how to deal with those kind of challenges. And once we have done this, the final output of all our efforts, 360 days of effort, is that we have the financial statements, and we also have a detailed disclosures and footnotes that we'll be talking about. And this will ultimately lead to our SEC filings, the filings that we have to do with Securities Exchange Commission. 10Q are the quarterly reports, interim reports, and 10K is the annual reports. So just for information, when people, I mean, if you're not aware of 10K and 10Q, 10K and 10Q are the annual, 10K is the annual report, 10Q is the quarterly report. And these are not financial statements, these are the annual reports. So financial statement is just one part of the annual report. So this will have lot many information, lot like director's report, management discussion analysis, so many other things similar to what we have in India, the annual report. Other than financial, it will have so many other things, including your auditor's report. So whenever we are talking of 10K and 10Q, it is not just financial, but it also covers more than financials. But for our area of discussion, we'll be focusing only on the financial statements. So moving on, let's start with the example. So I have got a trial balance here. So this is accounted, every element in this trial balance is accounted as per the US GAAP. So if I give you this trial balance, have a good look and let me know if you will be able to prepare a financial statements. What is your confidence level? Can you do 80% or can you do 100% just by looking at this trial balance? And if I give you a format of a US GAAP financial statement, let's say I give you balance sheet format, P&L format, cash flow format, you just need to pick the information, map it to a financial statement. What is your confidence level? Pratusha, do you get any responses? Can you see the responses, or
Uh,
is there a way by
Actually,
which you can keep it little interactive?
I think this is a webinar,
Okay, so
Navinji.
it's one way.
So yes.
All
So
right, all
maybe
right.
what we can do is, I think the technical support will help us with all the questions in the end. We can
Okay,
take it because it goes to the admin portal. But I believe it is not as interactive as a regular Teams call. So it could be like, maybe you can take them through
got it,
the
got it.
presentation
Makes sense,
and
makes
maybe in the
sense.
end we can do that.
Makes sense, makes sense. All right, guys. So looking at this, if I ask a chartered accountant in India, it doesn't look like there is any element on this trial balance which is difficult to understand. Maybe one or two elements, one or two items are difficult to understand. But if I give this financial statement to any chartered accountant, I think they will be with 90% confidence level, they will be able to prepare a financial statement. So preparing a financial statements as per US GAAP is not a rocket science. If you have a properly accounted trial balance, converting that trial balance into US GAAP financial statement, once we understand the format and requirements of the financial statements, it won't be difficult. So the objective or the purpose of this today's webinar is to increase a little bit of your confidence level, maybe from 90% to 95%, so that you are well prepared and informed of few of the specific requirements of US GAAP financial statements. So with that background, let's move on. Before I jump into the details of how to prepare or what are the content of the financial statement, let's pick up some challenging aspects of preparation of financial statements. So I personally feel that wherever there is a consolidation involved, it 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 amplifies the complexity. Uh, let's say if you have to prepare a standalone financial statements for a US GAAP parent company and you have a trial balance, I think it's nothing. You can easily do it. But let's look at some of the requirements of US GAAP for preparing consolidated financial statement. The first and the foremost requirement is that all your subsidiaries should also follow the same accounting policies wherever you're consolidating. So assume a scenario in if you have a subsidiary in India which is following Ind AS. So first of all, they are not following US GAAP, they are following Ind AS. And there is a possibility that the accounting policies, for example, your parent may be following LIFO for inventory, whereas subsidiary may be following FIFO for inventory. So that's one challenge where it makes it very difficult for a US company to consolidate an Indian subsidiary. Let's say if a US company has a subsidiary in US, then the possibility that both companies are following the same GAAP, both are aligning the accounting policies, there is a possibility it can happen. But if in case if a company, US company, have to consolidate a subsidiary in India, it amplifies the challenges. So the requirement whenever the US company have to consolidate a parent is the biggest requirement. They have to follow the uniform accounting policies throughout the group. So let's say if they have a US company has multiple multiple subsidiaries across the globe. Some of them are following IFRS, some of them are following Ind AS, maybe some of them are following some other accounting standard. Then it's a massive challenge for parent company. The other challenge, which is the reporting date requirement. So generally, like most of the US company, they follow Jan to December as their financial year, whereas India we follow April to March. So when US companies preparing their financial statement on 31st December, they are required to file their financial statement max by 15th March. They get 75 days financial statements by 15th March. They would end their year on 31st March and they start preparing the financial statements. So what are the practical challenges or solutions what US parent company can do to consolidate 31st March? So there are few relaxation given in the GAAP, saying first thing is that if the reporting date difference is less than 3 months, then we can adjust for the material transactions. And if adjustments are not possible, then we can at least disclose those. So there is a little bit of relaxation given in case of reporting dates. But in case if the reporting date is more than 3 months, then the subsidiary financial statements are to be recreated to match the parent entity's reporting period. So imagine like if a multinational conglomerate having subsidiaries all across the world, few of them are following March, some of them are June, some of them are August. It creates a lot of complexity in those scenarios. The other challenge is currency. All US companies are required to file their financial statements in US dollar. All domestic companies are required to file in US dollar, and all subsidiaries need to be translated. The financial statements of subsidiaries need to be translated to US dollar, and before consolidation. And some of the subsidiaries can be in a jurisdiction where they are required to prepare their financial statements in local language. For example, if a subsidiary is in Germany, then those subsidiaries are required to prepare their local financial statements in German language. But for consolidation, you may also have to translate the language so that it is readable and understandable. Imagine if a US company has a subsidiary in China, it I don't know what it's going to be even more complicated. So and also imagine a scenario if the subsidiary is not 100% owned subsidiary. Let's say if the US parent has got only 51% control or 50%, 51%, then the balance 41%, it can be held by another investor who would have a significant control based on other criteria other than investment. It can be a variable interest entity. So let's say the other parent company is IFRS, then there's an added challenge for Indian subsidiary to prepare one set of financial statements as per US GAAP, another set of financial statements as per IFRS. So just imagine the challenges the parent and subsidiary as well as the other parent who is consolidating the subsidiary can go through. Uh, it if it's a 100% owned subsidiary, then the challenges can be slightly minimized. If it is 100% owned, if parent companies have can onboard those subsidiaries onto their accounting platforms and ERP platforms, can influence the subsidiary to follow similar accounting policies. While there can be GAAP differences, but within the GAAP accounting policy, for example, both parent and subsidiary can follow common inventory valuation approach, common depreciation approach, uh, common approach for identifying or common cost measure approach. So there are a lot of similarities between India GAAP and US GAAP. So wherever there is similarity, at least they can follow it consistently. And moreover, if they are on the same platform, on same ERP platform or an accounting platform, then and one level of manual efforts can be minimized. At least ERP can help them consolidate. So And moreover, as a practice, lot of uh, subsidiaries which are 100% owned by parent companies. So parent companies influence them to close their books on a monthly basis. So we don't wait for year end to close our books to account for depreciations, to account for accruals and deferrals, but all Indian subsidiaries which are 100% owned by US parent companies, the requirement, most of them, they require the subsidiaries as they themselves close the books on a monthly basis. So they would definitely ask the subsidiaries also to close the books on monthly basis. So in that scenario, the reporting date challenge can be taken care because as on 31st December, the parent company can configure their ERPs to recreate a financial statements to match their reporting period. While that may not be audited, but still it is acceptable. Appropriate disclosures can be given in the financial statements. And moreover, if the Indian subsidiary is not significant uh, in the overall scheme of consolidation, if it is an immaterial entity, then those disclosures can also be avoided. So there are few flexibilities, so few exceptions in US GAAP, especially from a point of view of materiality. So if your parent company is, let's say, global giant, it's, let's say, Microsoft is acquiring a small, has a 100% ownership of a small Indian company, software company, then it's still, I mean, even if they are unaudited financial statements, even if they are not converted as per US GAAP, because they will also have to understand the transactions done by those subsidiaries. Are they significantly complex transactions, or they are straightforward purchase, sales, uh, accounting? So if most of the subsidiaries in India, US subsidiaries in India, they have a lot of restrictions by their parent companies not to get into complex derivative transactions, a lot of complex funding. So that way, the complexities applicable in US gaps can be avoided by the Indian subsidiaries, and it can enable the merging of gap. So with that background, let me move on to the next slide. Pratyusha, you can let me know in case if there are any questions coming up so that I can take it as and when it comes relating to this particular slide.
Sure.
Anything on consolidation?
As of now, no. I'll let you know, Naveenji.
Okay. All right.
Once I get to know the questions,
All
I'll
right.
I'll let you.
Sure, Pratyusha. Thank you. Uh, Moving on. So we have seen a scenario where a foreign subsidiary is consolidated with parent company, but there are chances that there are foreign companies who are raising funds in US through ADRs, American Depository Receipts. So they also have to file their financial statements with SEC. So the requirement for them is like they can follow any currency. So if, let's say, for example, Tata Motors have actually raised ADRs in US. So they are required to file their financial statements, and Tata Motors actually prepare their financial statements in INR, their consolidated financial statements in INR. So they don't have to translate or convert their INR statements into US dollar. They can file their financial statements as it is in US dollar, and the language required is again English. So let's say if a Chinese company is filing in US, it is not acceptable. They have to convert the financial statement in English so that the investors in US can read and understand those financial statements. GAAP requirement. So all foreign companies, either they can use US GAAP or IFRS, and even Indian GAAP is applicable. The only requirement is that in case if Tata Motors is filing their financial statements other than US GAAP or IFRS, then they'll have to provide a reconciliation to US GAPs, at least for the significant major differences between US GAAP and IFRS or IGAP, they have to provide the reconciliation. Uh,
So, Naveenji, it is very interesting that you had presented this, right? So, even in the previous slide also regarding the consolidation, I wanted to ask one thing that, probably can help participants also understand. Given the context of US GAAP, and we are predominantly, based out of India, where we have the India's preparation of financial statements, how do you think, how flexible is US GAAP in adaptable to, different accounting principles principles we have across the world. So how a company which is preparing in China versus India or Singapore, or how flexible US GAAP is in order to prepare these financial statements? Like, do we have a lot of similarities when we see between the accounting principles, or
Yes,
how
yes,
can, if you can throw some light, it can be helpful.
definitely, definitely. So I thought I'll cover that point once I cover these slides. I think there are more of similarities between India GAAP, IFRS, and US GAAP. There are few differences, which I think if you are aware of those differences, it is good. But otherwise, if an Indian accountant or Indian chartered accountant want to uh, pitch into US GAAP accounting options, it's not very difficult. Learning US GAAP is not difficult once you have learned India GAAP. There are more of similarities, less of dissimilarities. Uh, being aware of that, being informed of those differences between India GAAP. See, India GAAP is again like pretty much converged or merged with IFRS. So if you know India accounting standards, you pretty much know all of IFRS. There are few differences, still there are few differences, but still at least 90% gap is similar to IFRS. And US GAAP, IFRS, and India GAAP, I think there are almost 90% similar. Their differences are less than uh, common concepts. So it's not going to be very difficult in case of Indian accounting professionals want to leverage their knowledge of accounting standards and want to learn US GAAP. So I think one of the biggest difference between US GAAP and India GAAP is the applicability of regulation SX. So in India we have Schedule 3, but
Right.
when you look at the Schedule 3, probably it's a 1 or 2 pages. It defines the format. But if you look at Regulation SX, it runs into hundreds of pages, and that focuses only on the presentation. So one of the peculiar thing about US GAAP is it is very very detailed. It gives you, it doesn't give you scope of ambiguity or multiple interpretations. So it gives you a direct answer to every questions, every industry scenario. So there are so many prescriptions or so many guidelines given for industry specific accountings. So do we need to know everything on day one? May not be required, but aware of what are those provisions, what are those available options is will be helpful. So along with US GAAP, if you are venturing into US accounting practice, then awareness of Regulation SX is also required.
So, thank you. That is insightful. So, apart from Regulation SX, is there something that is, some regulatory body for US GAAP, like which is creating the accounting principles as such for the United States, which is coming up, like just like how we have the Ind AS board, like in India, we have the international standards for the IFRS. Is there a regulatory board for US GAAP also?
Yes, Pratusha. So all US GAAP are governed or managed by FASB, Financial Accounting Standard Board in US, and
Okay.
they are enforced by the regulatory authority SEC. So SEC requires all the financial statements to be prepared as per US GAAP, and also SEC requires that all registered companies or listed companies also follow the SEC rules for financial statements. So
Okay.
similar to India, we have got SEBI's Companies Act. Similarly, we have SEC to enforce the uh, application of US GAAP.
Okay. Okay. Thank you. You may please proceed to the next slide. We'll go through the slides.
All right, Pratisha, thank you. So on this, okay, so we see in domestic foreign companies the requirements of filing for the foreign companies. So while domestic companies file the 10K and 10Q, foreign companies are required to file another report which is called as 20F. But the content of financial statements of 20F is pretty much same, and we don't have to reformat or represent our local GAAP financial statements as per US GAAP. But if you're following anything other than US GAAP and IFRS, then a reconciliation may be required. So with that background, let's look at the actual content of financial statements. So once we have the trial balance, we are required to prepare a financial statement primarily we call as per financial position, which is actually balance sheet, earnings or net income, which is actually profit and loss account, and then we have comprehensive income, and then we have cash flow, and then we have statement of changes in equity. I think this requirement is pretty much similar to what we have in Ind AS. So as per Ind AS and as per IFR also, we are all required to prepare balance sheet, profit and loss account, again comprehensive income, statement of cash flow, statement of changes in equity. Ind AS or company Schedule 3 of Companies Act require us to prepare 2 years of comparative, but US GAAP requires 3 years for balance P&L, cash flow, and statement of changes in equity, and 2 years for balance sheet. So this is one of the difference between Ind AS and US GAAP. Whenever you're doing US GAAP, the requirement is that the minimum requirement is that you do 3 years and 2 years for balance sheet. But generally, as a practice, when all the financial statements are 3 years, so most of the organizations they prepare their balance sheet also for 3 years. So that's okay. This is the minimum requirement, but if you present more, that's perfectly all right. And along with financial statement, notes to financial accounts are also required to be prepared. Notes to financial accounts are considered to be integral part of financial statements. We'll look into the details of the notes to financial statements in when we prepare, once we have the trial balance and once we move on to preparing our financial statements, few things that we need to be aware of, few do's and don'ts, that's something. So one of the biggest thing is like offsetting. So offsetting is basically presenting assets and liabilities or income and expense as net amounts rather than presenting a gross. So let's say, for example, I'm giving a hypothetical example. You have some deposits in bank and you 10 lakh rupees and you have borrowed, let's say 8 lakh rupees against the security of that deposits. So can bank present net 2 lakhs of deposits? Can it offset? Is it allowed or not allowed? So those are few of the questions which we are trying to answer here. So while we will not be discussing the financial statement requirements of a bank here, this is more for industrial and commercial organizations. So I've just gave you an example so that you understand the concept of offsetting, whether we can offset our deposits against loans or not. Similarly, there can be a scenario where you have day-to-day buying, purchase and sale transactions with your customers. There can be a scenario where you have sold your finished goods to the customers for reselling or maybe their consumption, and you might have bought the raw material from the same customer. So can you offset receivable and payable? So few of the examples, and as per US GAAP, offsetting is permitted where both US GAAP explicitly permits and regulation accepts doesn't prohibit. If both are in sync, only then offsetting is permitted. If either of them is explicitly mentioned or prohibited offsetting, then we can't offset. And wherever offsetting is allowed, then we have to clearly disclose in our notes to financial accounts. What are the disclosure requirements? We have to disclose the gross amounts into notes as well as the criteria for offsetting and so few of the examples where offsetting is allowed and offsetting is not allowed. If you look at this table below, so in case of derivative investments, offsetting is allowed if the criteria is basically if there's a legal right to offset and also there's an intent. So wherever there are derivative transactions like option selling and option purchase, so in that case, you can present a net amount instead of presenting gross. Another area where we have accrued discounts or premiums on investments. So basically, when you buy or when you invest in securities, listed securities, you may, or unlisted securities, you may end up paying sometimes premiums. So, or sometimes you may get it at a cheaper cost and you may get discount. So those kind of offsetting is allowed, but it is allowed only against. So it cannot, all investments cannot be grouped together and one offsetting of one investments cannot be done against another. But if it is within investments, the offsetting is permitted. deferred tax assets and liabilities. Can we do that? So let's say if we have a deferred tax asset in US and we have a deferred tax liability in India. So can we do that? We will end up paying income tax in India, which cannot give us any benefit in US. So we may not be allowed to offset it. So it's permitted to offset enforceable right. So for let's say parent and subsidiary has a liability, then deferred tax can be presented as a net amount in the consolidated financial statements. What is not allowed to be set off? Basically, setting off trade receivables and payables, setting off revenues and expenses, and setting off of different legal entities, setting off across different legal entities. So these are some basics. I think we have similar requirements in Ind AS as well, but Regulation SX and US GAAP specifically mentions that when we prepare the financial statements, these are few of the rules that we need to follow for offsetting. All right, moving on. Let's look at some of the procedures for accounting for changes in accounting policies and error corrections. So there's a possibility that current year we may have changed our accounting policy, let's say from LIFO to FIFO, or maybe current year there is a new accounting standard which is introduced, and we have adopted that accounting standard. Whereas we have seen that our financial statements we are required to present for 3 years, 3 comparative years. So if we change or if we apply the accounting policy only to the current year, then we are not complying with the consistency and comparison. So prior year financial statements that we present as part of our financial statements, prior year columns are as per different accounting policies, and current year it's a different accounting policies, which is not acceptable. So therefore, wherever there is a change in accounting policy in current year, we may have to restate all the financial statements that we are presenting, all 3 years of income statement. And if you're presenting balance sheet for 3 years, otherwise for 2 years, whatever we are presenting, if you're presenting for 5 years, let's say, then we may have to restate all the balance sheet, that all the financial statements, all the comparatives that we are presenting on the financial statements. And so that is for change in accounting policy. There can be a change in accounting estimates. So for example, initially we estimated that our warranty claims would be 5%, but now we based on the actuals, we see that it is 7%. So wherever there's a change in the estimate, those kind of estimates are not applied retrospectively, but they are applied prospectively. So if we have identified that the change in warranty is 7% from current year, so from current year onwards, we have to apply that subsequent correction of errors. So if you have identified related to current financial year, then it will flow through your trial balance. So you don't have to make any more change in current year relating to the error is related to prior year. Then we have to restate, correct the financial statement presented on the face of the financial statements. Hope that is helpful.
Yeah. So actually,
Sorry,
sir,
Pratyusha.
one recurring question that I've been seeing in the questions from the participants while you explain the slides, they want to understand how these events, or like, how these steps that you have mentioned for US GAAP are different from the Indian GAAP. So they want to understand simultaneously as to how, how the presentation under US GAAP is, and is there a major difference under Indian GAAP is, like, what are the differences? So they want to understand that differences is what I can understand from them.
Yeah, actually, if the class would have been interactive, I would have asked that question to the participants, because all the participants here are chartered accountants, and then they know what are the requirements as per Indian accounting standards. So can they tell me so far, did they see any difference? So far, whatever I have explained based on US GAAP, have they identified or have they seen any difference? The only difference I have seen so far is the requirement of the comparatives. Otherwise, there is no difference. As I said, there are more similarities than dissimilarities. So if you have learned how to prepare your financial statements based on Indian accounting standards, you are good to go with. The only challenge is that the trial balance that is given to you should have been prepared as per US GAAP. So there are many more differences in your initial recognition and measurement and subsequent recognition. But when it comes to preparation of financial statement, presentation of financial statements, there are more of similarities and less of dissimilarities. We'll see into the format as well. The format is slightly different. I mean, I would not say it's majorly different. Again, the US GAAP has given flexibility. So in case if someone wants to follow Schedule 3 format, also they can. So just that in Schedule 3 of Companies Act, there is only 2 years of comparative, but we just have to make sure that we have 3 years of comparative here. So I mean, the accounting
yeah.
changes what you have seen in the previous slide. I think this is exactly what we have in our India GAAP as well. So this is nothing, no difference at all. So once you're done with this slide, you will realize that, I mean, so far you may be fearing, oh, US GAAP is something big or something complex. It's not actually, it's not very complex. So if you're confident with your Indian accounting standards, you can go ahead and start pitching in for US GAAP work.
Okay.
Sorry, Pratisha, you're saying something?
No, so basically, whereas when it comes to, you mean that when it comes to the presentation, we have a lot of similarities between Indian GAAP and US GAAP. But whereas when it comes to the initial recognition or while preparing the trial balance, as you mentioned, like while accounting, we will find dissimilarities between these both. Is that right?
We'll see dissimilarities, but again, the dissimilarities are less and similarities are more. So I can say that there are more similarities between US GAAP and Indian accounting standard. There are few industry specific standards, for example, for financial institutions, for insurance companies, and for non-profit, or they have got specific requirements that can be majorly, or that can have a big differences between Indian accounting standards, as because they are industry specific and which are massively rule based. So you don't have any scope for deviation. But otherwise, for general purpose financial statements, there is a little bit of flexibility, so not a big challenge, not big difficulty.
So can we say that, with the introduction of I mean the convergence between Indian GAAP, IFRS has really made it easier for the integration with US GAAP also, given that, particularly with certain standards like revenue recognition and, certain PPE. So the convergence gets easier because of the convergence with IFRS. Can we make that statement? Okay.
Yes, you're absolutely right. See, there are, I mean, if you look at our good old Indian accounting standard that we had, if you compare that, then there will be a lot of dissimilarities. But now IFRS uh, has got more similarities, and moreover, now US GAAP is also trying to align more and more with IFRS. And currently, they are running into projects where they are trying to simplify their financial statement presentation framework. Maybe by next year, hopefully we'll have that as well. So we'll see more similarities between IFRS and US GAAP evolving over in near future. So the dissimilarities will slowly vanish. I think the biggest difference between US GAAP and IFRS is driven by Regulation SX, because as Regulation SX is a law by SEC, which is specific to US. So they want their registered companies to follow certain rules, certain procedures in presentation, so that they maintain consistency across all the filers. So they just want to eliminate the scope for ambiguity, eliminate the scope for multiple interpretations. So they have defined detailed rules of what to do and what not to do. But again, when I see it, it won't make a big difference. Once you understand it properly and correctly, you will see that there's not much of a difference between what we do, except for those industry specific standards. So not much to worry about US GAAP as such.
Sure. Thank you, sir. Thank you for that.
All right, guys. So moving on. Most welcome. Subsequent event on my screen. Can you correlate this back to your Indian accounting standard? I think we have something similar. May not be exactly same, but there are two types of Subsequent events are like the events which occur after the balance sheet date, up to the date when the financial statements are authorized for issue. And SEC says till they are issued. So there can be a 1 day gap between authorized for issue and for issue. Generally, organizations manage to issue the financial statements on the same day when that is authorized. So the gap is eliminated. If something happens in that 1 day, they don't have to recast or redo their entire financial statements. So there are practical challenges when it is authorized for issue, and when it is actually issued, if the gap is multiple days, then it can create a problem. There is a risk that if fire can occur in those couple of days, something else can happen. So keeping that aside, let's look at the subsequent events that requires a adjustments or a recognition in financial statements, and the events that may not require an adjustment to the financial statements. Events which doesn't require adjustment to the financial statement would still require to be disclosed. So events which are required to be recognized in financial statements are like the events which provides additional evidence about the conditions that existed at the balance sheet date. We'll see a few of the examples, like 1 or 2 examples we have here. So whenever we have additional events, let's say for example, there was a lawsuit as on 31st December, we had that lawsuit, but we are not sure whether what will be the outcome. So we might have already disclosed it as part of contingency, but before we issued our financial statements, let's say 31st of January, we lost the lawsuit and we have a liability. So we have to recognize that liability in a financial statement. Previously it was a disclosure, but now it is a charge. It's a charge to a P&L, directly reducing your profit. So we will have to make that adjustment before we can issue the financial statement. Another example that I have here is the bankruptcy of the customer. So as on 31st December, you had a customer who was supposed to owe you, let's say, $100 million. But before you have issued your financial statement, that customer has filed a bankruptcy. So before you issue the financial statement, you go back, write off that customer in a financial statement, take a hit to a P&L, and then readjust the balance sheet or readjust the financial statement. Event has no connection to the conditions existing on the balance sheet date, so it does not exist on the balance sheet date. So in that case, we just have to disclose. For example, if a fire occurs before the issue of the financial statement, then we just need to mention in our notes that the fire has occurred, and if we can quantify the financial impact, we have to disclose the financial impact as well. But if it is practically not possible, then we can also say why it is not possible. So, and again, like the disclosure is required only if the uh, non-recognized material. You don't have to disclose every small things in the financial statements. So this is an example. For example, how do we disclose a subsequent event which is non-recognized? If it is recognized, then you adjust the financial statements. But if it is non-recognized, then you can just see an example here, the company assessing the extent of damage of evaluating. So there's a fire. So they have given a disclosure in the financial statements saying on so and so date there is a fire, and is evaluating the damage for insurance cover, as this event occurred after the reporting does not relate to conditions existing at the time. It's not been recognized in the financial statements. Let's look at some of the examples of subsequent events that are required to be adjusted and that are only required to be disclosed. So we have seen the lawsuits, whatever is the outcome, we have to adjust the financial statements if that lawsuit was pre-existing on the reporting date. Bankruptcy of the customers we have seen. But let's say if a new lawsuit is filed after the reporting date, then we don't have to adjust our financial statements. We just need to disclose that a new lawsuit is filed. We have seen the example of fire. We don't have to adjust the financial statements. Let's say we have finalized a acquisition after the balance sheet date. Then again, we just need to disclose. We don't have to go back and adjust our financial statements and start consolidating our mergers. Let's say going concern uncertainty arises after the year end. So in our financial statement, just like our India accounting standard, we have to give a statement about our going concern capabilities or abilities. So there are specific disclosures required by US GAAP to ascertain the going concern abilities of the company. So in case if the going concern becomes uncertain after the balance sheet date, so after balance sheet date, there are situations that have arisen which makes it difficult for the organization as a going concern, then we just have to disclose. But if the conditions was pre-existed but are confirmed after the balance sheet date, then we may have to go back and redo our entire financials based on liquidation basis accounting. COVID related effects. So COVID has impacted a lot of businesses, especially in travel and tourism in a big way. So first year, if the as on 31st December, uh, if there were no conditions existing of COVID, but if COVID has or lockdowns have been announced or COVID have been declared after the balance sheet date, then we just need to disclose. And COVID continued for a couple of years. So I think 3 or 4 years. So first year it requires a disclosure, but later years, because it is no more a subsequent event, it was an event which was pre-existing. Uh, and it's like a BAU now. So you don't need any adjustments or any disclosures. Voluntary disclosures of impact on your financial statements are encouraged, but GAAP doesn't require any additional disclosures in subsequent years. Few special things that we need to look at is, let's say, settlement of liability. So you have a liability in your financial statements. You may have to. Uh, so the liability was initially classified as non-current. Probably we'll touch upon the current and non-current, but for now, non-current is something which is due after 1 year. So assume on the balance sheet date you had a liability which was due after 1 year, but you paid it off before your balance sheets are issued or your financial statement is issued. Then, even though as on the reporting date there was no condition or there was no situation that we would pay then we have to reclassify the liability from non-current to current. So basically it says that it's the and the criteria is that the intent of the management have to be looked into. If management had an intent on the reporting date, that intent itself is a condition which was existing on the balance sheet, and therefore the requirement is that non-current liability which was non-current as on reporting date have to be reclassified as current. Similarly, debt refinancing. So debt refinancing, like a lot of debts which are maturing in next 12 months, there is a possibility that they may not be refinanced. There's a possibility that they may be refinanced. So in case if a debt is maturing or if a debt is supposed to be settled in next 12 months, so generally they are classified as current. But in case those current debts are refinanced or at least the agreement is entered for refinancing before the reporting date or before the financial statements are reissued, then those current debts have to be reclassified as non-current. Similarly, dividends which are declared and proposed after the reporting date doesn't require any adjustments to the financial statement. They just need to be disclosed because these are the events occurring after the balance sheet date, which doesn't have any pre-existing condition as on unless until it's approved. So the condition for dividends is approval. So we don't know whether we shareholders approve or not. So therefore, we don't adjust the financial statements for dividends declared. All right, so let's move on to the individual financial statements, format, content, requirement. Any questions, Pratyusha, that I can take?
Basically, there was a question regarding US GAAP for non-profit 503C organizations. So, sorry, CA Sarita had asked to, sort of throw some insights on US GAAP for non-profit organizations.
So that's a complete. I
Yeah,
would say it requires independent or a different webinar altogether. It's difficult to cover in this one hour. I think we have got so many other things. Probably if she can connect with me, I can try to help her over a WhatsApp or a email, but uh,
sure.
covering
I think
non-profit, I
that
mean industry specific, it will be possible.
Right, right. Uh, and actually, there is one observation. Maybe you can correct them, or maybe you can
Yeah,
validate it. They said that the subsequent events that you had just discussed in US GAAP is very similar to the AS4 under Indian GAAP. Is that a right
absolutely.
observation?
Absolutely. Yes, 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 absolutely. Absolutely. There are more similarities than dissimilar. Maybe one or two items which are allowed. For example, cash equity transactions, right? So here it requires, US GAAP requires that to be recognized and adjusted, but India GAAP doesn't require that to be adjusted. So in case if you are issuing uh, share splits, or if share splits are happening after the reporting date, so I think there are few tiny differences, but otherwise, if you take this
Broadly
list,
same.
compare it back to India, I would say at least 90% of the items listed here would exactly match.
Right,
So there are more of similarities and less of dissimilarities. That's what I'm saying. Be don't have the phobia of US GAAP or the fear of US GAAP. US GAAP and India GAAP, they have got a lot of similarities, less of dissimilarities. I mean, if you do a comparative studies, you will realize that there are very few differences between US GAAP and India GAAP.
right. I think given how similar we have, between the US GAAP, the examples that you have given and the kind of preparation that we do under Indian GAAP, I guess it is very easy for us to go ahead and start preparation under US GAAP also. Like you mentioned, it is not really an intimidating factor as such to say, oh, it's a
Yes,
US
yes, yes,
GAAP. So
absolutely, absolutely.
uh, okay,
Exactly,
okay,
exactly. See, the challenge or the challenge with US GAAP is when you start reading US GAAP, it is written in such a language, it is very difficult to understand it. When you read the original literature of US GAAP, it is written more of in the legal language, with sections, subsections, clauses, subclauses. So if you try to read US GAAP the way it is actually drafted, it feels it is very complicated. But
okay,
if you actually read some of the books or some of the literature which have simplified it, you feel that there are a lot of, I mean, a lot of big fours have published their comparative study between US GAAP, India GAAP, and IFRS. It is available free of cost on uh, internet. So I would recommend that you go look for some of those documents, some of those
document. Yes.
yeah, and you'll realize that. But if you start reading Regulation SX, or if you start reading US GAAP the way it was published originally, you will be lost. I mean, it runs into thousands and thousands of pages. Each gap runs into
Okay.
hundreds of pages. So it becomes practically difficult or to understand. By the time you start and by the time you end, you will be lost. You will not know what you have learned. So, summarized form of the crux of US GAAP. Yeah.
Okay. Okay. Sure, sir.
All right. So moving on to balance sheet. So what is the format of balance sheet basically? I mean, there are two formats, basically classified balance sheet and an unclassified balance sheet. So for all commercial and industrial entities, when we say commercial and industrial entities, we mean all general purpose businesses who are profit oriented, which are like not non-financial institutions. I mean, say excluding financial institutions, excluding banks, or excluding insurance companies, excluding non-profit. So general purpose financial statements, they are encouraged. It's not again mandatory, but they are encouraged or recommended to follow classified balance sheet format. So what is classified? Basically, the requirement is that you classify the your assets and liabilities into current and non-current, right? Whereas banks, financial institutions, for them it will be difficult to classify as current and non-current. Therefore, they are allowed to, or they can follow unclassified balance sheet as well. So when we say current and non-current, we have to classify both our assets and both our liabilities into current and non-current. So generally, it is assumed that whatever assets and liabilities which are expected to be settled within your operating cycle, or if operating cycle is more than 1 year, then probably you assume it's 1 year. So anything which is expected to be settled within our operating cycle are considered to be current. And any assets and liabilities which are expected to continue in balance sheet for a longer period, those are all non-current. So I think we have got a similar requirement as per Ind AS. While I think Schedule 3 doesn't have any specific requirements on presenting current and non-current, but I think Ind AS, if you see Ind AS 1, there is a mention of classified balance sheet where we are required to classify our assets and liabilities into current and non-current. And what is the order of presenting assets and liabilities? Do we start with assets and end with liabilities, or should we start with liabilities and move on to present the assets? So generally, there is no preference. You can start with assets, you can start with liabilities on the top. Again, like within assets and liabilities, you can start with current assets or maybe non-current assets. Those flexibility within the format is given, but whatever you follow, it has to be consistent. Generally, the preferred order is the order of liquidity. So you start with the most liquid asset on the top, or you start with the least liquid asset on the top and then move on to present the. So maybe you can start with fixed assets or property, plant and equipment as first line, and end up with cash and cash equivalents as the last line in your asset section of your balance sheet. So what is the format or the minimum captions? Captions are basically minimum terminology. So US GAAP doesn't have a specified format. Some similar to Ind AS. Ind AS has not specified a format, but we have got Schedule 3 of Companies Act, which has specified a format. So similarly in US also we have Regulation SX. They're not given the format as such, but they have asked for the minimum content of the financial statements, both balance sheet and income statement. So what are the minimum requirement of balance sheet as per Regulation SX? So there are captions and subcaptions. So basically starting with cash and cash items, I think we have similar things in our Schedule 3 as well. We have a separate disclosures for restricted cash. We have got marketable securities, accounts receivable and notes receivable. Again, like we have to provide a breakdown, how much of that is from trade, customers, related parties and promoters. And again, like here they have aggregated accounts and note receivable, but in case if notes receivable are more than 10% of aggregate, then you have to present it separately. There is a requirement to present allowance for doubtful accounts. Wherever you see this subscript 1, that means those elements can even be presented in. You don't have to. So if you present the accounts receivable gross and allowance for doubtful debts, there is one way of presenting it, or you can present the account receivable net and present the allowance for doubtful debts in notes to accounts, or you can provide a simple table or a schedule in your notes to accounts to explain the accounts receivable. Similarly, we got all unearned income, inventory. Again, inventory, wherever we are presenting inventory, we have to present the inventory into finished goods, work in progress, raw materials, etc. Again, this presentation can move to notes to accounts in case if disclosures, we have to present what is the basis for determining what accounting policies we are following for inventory, prepaid expenses, other current assets. So other current assets something, I mean, like if we cannot dump everything, if any one element or one item in other current asset is more than 5% of total current assets, then they have to be presented separately on a separate line. When we say minimum caption, one thing you have to be aware of that is when we say minimum, it's like there's hard and fast rule to present all these captions in the financial statement or a balance sheet. In case if any of this is immaterial, insignificant, then US GAAP will allow you to group them with a similar caption, which is pretty much similar in substance. And also, if, for example, if you don't have prepaid expenses, then do you have to present this in the face of the financial statement and present 00? No, not required. If something is not applicable, then you can exclude that. For example, if some of the organizations may not have marketable securities at all, so it doesn't make sense to present a blank row on the face of the financial statement, you can ignore. So when minimum captions subject to materiality and applicability. So always we have to keep this in mind. But wherever it is applicable and wherever it is material, we have to make sure that we are presenting at least this. So similarly, we have got captions for liabilities. These are like non-current assets. We have got all the captions for non-current assets, how we present property, plant, and equipment. So similar to India accounting standards or India or Schedule 3, whenever we present property, plant, and equipment, we have to present a detailed fixed asset schedule in our notes to accounts, providing a breakdown of the composition of the total property, plant, and equipment, the accumulated depreciations for current period, the sale and purchase of property, plant, and equipment in current period, all the movement of uh, and all the transactions, major transactions related to property, plant, and equipment have to be presented as part of our schedules. So moving on, like we got the entire list. This list is defined by regulation SX. So and this is so in the listed companies specifically, they have to have this minimum content on the financial statement. Again, like regulation SX is not applicable to unlisted companies. So unlisted companies can follow GAAP. Again, unlisted companies, US GAAP is not mandatory. So you have to, I mean, most of the companies prepare their financial statement as per GAAP, but that is voluntarily, but it is not mandatorily applicable to unlisted companies. So one of the factor which can actually take off a lot of your fear is like US GAAP and regulation SX is applicable and is mandatory only to the listed companies in US. So for example, like US may have 10 million businesses. Out of that, only approximately 7,000 are listed. So you can imagine the scale uh, of scope. I mean, even if you're not aware of US GAAP or if you're not aware of regulation SX, still there is a huge market where you can pitch in for work. So, I mean,
So the preparation of the financial statements for those companies can be taken basis the guidance of Regulation SX, or it can be prepared in, like you said, it is not compulsory to be prepared in US GAAP. So
yes,
it can be prepared in any manner for the companies which are
absolutely,
not particularly
absolutely.
listed.
If you're
Okay.
following, yeah, if you're following the I mean, the IRS, which is like income tax department for in US, allows you to
Yes.
account for cash basis as well. So there is no
Right.
requirement that even you have to follow an accrual basis accounting. So even if you don't know accrual basis accounting, still you can pitch in, because if you're not filing with SX, the only regulatory authority that you may be filing is your local state secretary of affairs, company affairs, which doesn't prescribe any requirement. You just need to file their financial statement. They just want to know your profit as per your financial statement. It doesn't require you to follow a particular specific gap. So even if you are filing your financial statement prepared as per Ind AS, if it is not listed with a local
Okay.
state secretary, they would still accept it.
Okay, okay. So
So
that has been something that was very prevalent when, I think US recognizes the cash basis of accounting, whereas particularly when we look at the Indian scenario, we are more into the
also, I mean, income
accrual.
tax department, I mean, we have got
Right.
tax experts on this forum, but I think still it allows you to do your financial accounting as per cash basis.
Okay, okay, okay. And one question I've got regarding this, Navinji, is what is the role of PCAOB? I believe that is Public Company Accounting Oversight Board,
Yeah,
as
yeah.
compared to FASB and SEC in this context.
So,
So,
yeah.
yeah.
So the evolution of accounting standard is over the, if you get into the history of evolution of uh, accounting standard, I mean, there have been so many governing bodies. They have been moving from one body to other body. So Public Company Accounting Oversight Board is specifically an accounting oversight board which has been created after Enron uh, to govern the public companies. I mean, they oversee. I mean, they are not the authority for issuing the accounting standard, but they oversee the issuance of the. They oversee that whole process. I mean,
Okay.
it's absolutely irrelevant as to which authority issues. So if we have US GAAP, I think FASB is the governing body for US GAAP. So anything which is coming from FASB, we can take it as authoritative literature or authoritative guidance for US GAAP.
Yes, okay.
And the
Okay.
other authoritative is regulation SX. So we always have to follow Regulation SX and FASB pronouncements. Everything else is irrelevant.
Okay. Okay. And I think one of the other questions that we want, I mean, candidates wanted to know was like, where do we get this as regulation SX? As in, is there any portal that we can
Yes.
access to get the content or get the
Yes,
material
it's
on
available on
regulation?
Google. It's available on Google. So you just need to type Regulation SX and you can find it. I can quickly show it to you if you want. Do me now. Just let me share my screen and let me try to show if I can do it now. Just give me 1 second.
Sure.
Let me quickly share my screen. So I've searched for Regulation SX. It takes you to the SEC website.
So we are seeing your email, Gmail actually. The screen that we are seeing is
Okay.
actually Gmail. Yeah.
Okay. You are able to see Google.
Yes. Yes.
Okay, just search for Regulation SX. Then it takes you to the SEC website, which is Securities and Exchange Commission website.
Okay.
There you will see all major regulations that we need to be aware of is Regulation SX and Regulation SK. So Regulation SX primarily governs or primarily covers the financial statements, and Regulation SX covers rest of the content of annual reports, either quarterly reports or annual report. So when you look at 10K or 10Q, it has got much more than financial statements. So financial statement is covered by Regulation SX, and SK covers the rest of the requirements of annual report.
Okay.
So the moment you click here, it takes you to the another website which is specifically, and you see all the codification here. You can start with table of content. It has got exhaustive content on just for preparation of financial, and majority of them is covering the consolidation form terminology. So how do we? I mean, you can see here like basically this is for commercial and industrial companies. So basically, these are all general purpose companies like a software company or maybe a trading company or a manufacturing company. But there are industry specific guidances for investment companies, business development companies. There will see lot many other uh, insurance companies. So industry specific guidances are available here.
Okay.
And there is a lot of relaxation given to small reporting companies here. So if again, like there are companies whose turnovers are less than 75 million threshold, so they are classified as small reporting companies. So a lot of relaxations is given to them in terms of interim financial statements, in terms of comparatives. I mean, by like for example, general purpose entities are required to present 3 years, but they may be they are allowed to take a bit of relaxation on those companies. I mean, industry specific, and somewhere we'll see for oil and gas as well. So there are specific guidance for real estate companies. So broadly, this is regulation SX. And similarly, if you go to regulation SK, I mean, while we as an accountant may not be required to get into regulation SK, but when you approach a client, they don't want to deal with multiple consultants. So they want one point of contact to prepare their annual reports. So if it's a listed company, then they have to prepare an annual report. So they don't want to deal with multiple consultants, one preparing only financial statements, another preparing others. So especially small businesses. I mean, as a Indian consultant, I cannot imagine a situation where you can go and get a Microsoft as your client, but you generally pitching for small clients, and small clients want one point of contact. So it will be good if you also understand the requirements of regulation SK. So all of this is the content for regulation SK. Again, as a word of caution, whether it is regulation SK or SX, if you read on this website, you will be lost, because this is all legal terminology. If let's try to read one paragraph and see if we can understand any of those content, it makes it very, very difficult.
Okay.
So I would recommend use ChatGPT.
Okay.
Start with a question. Can you please explain what is regulation SX? It will give you at least 5 pages of content. Then accordingly go step by step. Ask simple questions to ChatGPT, and by end of the day, you will be covering entire regulation SX. You don't really, if you start with this, you will be lost. You will never be able to come to a conclusion.
This is as such probably equivalent to the bare act of any law. So
exactly. This is more like a bare act of a law. So let's look anything. Let's pick. So we'll cover comprehensive income on slides, but if you look at, they have got sections, subsections, clause, subclause, and somewhere they will give reference to another subclause, and you have to go back and read those subclauses as well somewhere. So this makes it very difficult to understand, and this is the biggest problem with US GAAP. The way they have written is all like a legal terminology or a legal drafting.
right.
So this is regulation SX. Everything is available on, and I'll also show you where you can actually see the original pronouncements of for US GAAP. So this is the FASB website. So if you just go here, and these are the codifications, or these are basically the accounting standards. So if you go to FASB website, you will see accounting standard codification here. So you just need to agree to the license agreement, and that's it. You don't need any subscription or any payment here. Okay. On this site, you will see all the accounting standard codifications. So general principles, starting with 105, it goes on industry specific. It goes on till 995. So if anybody, someone was asking for industry specific accounting standards. So if you go on this website, if you go to industry specific, you can see all industry specific guidance here. So extractive activities is basically for all oil and gas and natural resources extraction industries. We have got specific accounting standards for airlines, agriculture, contractors, development stage company, entertainment, financial services. Everything is listed here.
Right.
And if you want to look at the revenue recognition, again, like all the accounting standards, 605 is for revenue recognition. 606 is revenue from contracts. And then we have other incomes. So all 605 to 610 is all about revenue recognitions. You have got expenses, various kinds of expenses, We've got specific standards for stock-based compensation, equity. You can find everything here. So the slides that we have seen here, 205, presentation of financial statements. We have got balance sheet, statement of shareholders' equity. So the content in my slide is coming directly from this website. Notes to financial statement. So we got accounting errors, earnings per share, interim financial limited liability entities. How do you present the financial statements of limited liability entities? So if you want to have these are basically like unregistered or unlisted companies.
Okay. Okay.
All right. And I'll also quickly show you SEC website. If you want to go through some of the best way to learn US GAAP is read some of the published financial statements. So if you just search for SEC, it will take you to these. Here it's all the listed companies file their financial statements on SEC websites, and it is available to all the users free of cost. So we can see the financial statements of Microsoft. We can see the. So we have to go to search Edgar, and we just type, let's say, look for Amazon. So to list you.
I think the spelling, yeah.
So you can see the listing. Yeah. So again, like there are so many different filings, but we should look for 10K, which is a annual report. So just filter on 10K. Yeah. So you can see Amazon.com. They have filed their annual report on 7th February 2025. Sorry, this is not 10K. This is just one of the exhibit of 10K, but we'll look into a full 10K. This is again of 10K. I think we are doing something wrong with this. So filter on 10K and then filter on. We just want for Amazon.com.
Okay.
Now we can see the annual report, which is filed on. Yeah, this is the 10K. Now, if you look at 10K, 10K is annual report. It is not just financial statements. So it has got all the specific requirements. There's a lot of information, all this section, what we see, how the name should be presented, everything, what you have a lot of check boxes here. So if you see here, as per SEC, organizations are classified as large accelerated, non-accelerated, and small reporting companies. So because Amazon is a large company, because I think the criteria is more than 700 millions are classified as large accelerated. So they have tick large. But if your turnover is less than 75 million, you'll be classified as small reporting companies. The moment you classify your company as a small reporting company, you get a lot of relaxation, you get more time to file your return, you get a lot of relaxations on application or applicability of regulation SX and US GAAP. So there is less of scrutiny basically if you're a small reporting company, and if you are large and accelerated filers, there is a lot of scrutiny. So if you see the content of 10K, it is part 1, part 2, and our financial statements are on item 9. So this is standard format of 10K. So you cannot choose to file your financial statement in item 6, business description of your business should always be in item 1, risk factors should be in item 1A. So this is a standard format of 10. If you don't, if let's say for example, one of this is not applicable, so you have to leave it blank saying this is not applicable to my business, but otherwise you have to follow this format. So part 1, part 2, part 3. So if you go here in financial statements, and then we have got all the exhibits here. We got the exhibits of including in case if there are any additional schedules to financial statements, we can do. So if you go to the financial statements, we can see the report of the auditors. We have got consolidated cash flow. So you look at the order, they are starting with cash flow. Generally in India, we start with balance sheet and then move on to preparing P&L, and then we prepare cash flow. But here there is a flexibility. You can do whatever is best representation of your business. Someone was asking about public company accounting oversight. So this board is more to oversee the auditors and auditing aspects of the accounting standards. So we can see they have presented all 5 financial statements along with notes. So let's quickly go to the financial statements. So cash flows, as we have seen, they have presented all 3 years. If you see the order, they are starting with the oldest year first and then moving on to the latest year. But if you recollect back our schedule 3 is always current year on the left and then older years or the previous year in the subsequent columns. But here they have. So is it allowed? Yes, you have flexibility. You can do either ways. You can start with current year on the as the first column, or you can start the third year as the first column, and you can present your financial statements. So they have chosen to start with cash flows. Moving on with income statement, and then we have statement of comprehensive income, and they are presenting their balance sheet. So as required, they are presenting just 2 years of balance sheet, or they could have chosen to present 3 years because all other statements are 3 years. So statement of changes in stockholders' equity. So you can see here they are presenting 3 years and all the components. We will see this in our slides as well in subsequent slides. And looking at the notes is very, very detailed, very descriptive, and it runs in almost like 30, 40, 50 pages. We don't know, but these are very elaborate. I would recommend you to go on that SEC website, look into few of the Amazon, pick Coca-Cola, whatever you think, and just go through their financial statements and understand and try to analyze the differences between what you do in India GAAP and US GAAP. So that itself will give you enough ground to gain some confidence for US GAAP reporting. All right, with that background, let's move on to my presentation. I think we have just 30 minutes left, right?
Yes, we have around 30 minutes left. So
Okay.
since we are taking the questions simultaneously, maybe what we can do is, sir, you can cover the presentation.
Okay.
If I,
Let me quickly run through, and I'll stop
yes,
wherever we have something critical to
sure.
discuss. But otherwise, I will quickly. So we have seen, I mean, these are all the minimum captions, and these captions are available on SEC website. Probably you can share these slides as well with all the participants. So I'm not going to go into individual details. Coming to income statement again. Income statement, generally the traditional income statement, we had income statement, but as after IFRS, I mean, even India's one also require the inclusion of other comprehensive income as part of income statement. So income statement is always 2 part. One is income statement and the second part is other comprehensive income. So now you have a choice. You have an option. Either you can present both together as a single statement, or you can split both of them and present 2 separate statements. So if I remember what did Amazon did, let me quickly tell you. I'm sharing my screen, but I'll tell you what Amazon has done, whether they have presented 2-step or single step. So Amazon have presented 2 statement approach. So they are presenting net income statement separately and other comprehensive income separately. And what I have seen, majority of the US companies follow two statement approach. That's fine, because I mean it looks good on the face of the financial statement, but otherwise reading a 50 rows of P&L is going to be very tedious. So what is the content of net income? So basically it's all your operating income and expenses day to day, all your taxes, all your discontinued operations. And what is the content of other comprehensive income? Basically these are income, or these are the kind of income which cannot be part of your income. So mostly these are like unrealized gains or losses driven by valuation. So temporarily unrealized gains and losses driven by valuation, which may reverse out in near future. So there is a possibility that when you do a consolidation of a foreign subsidiary, you will translate your foreign subsidiary to your reporting currency, and that can result in some sort of a translation gain or losses. If that results in a translation gain, you are not allowed to book that as your, or not allowed to report that as part of your income statement, but that is required to be presented separately as part of other comprehensive income statement. Similarly, we have got available for sale security, basically debt instruments, which are required to be valued at fair value, and gains or losses are accounted through other comprehensive income. We have got a lot of pension and post-retirement valuations. I think mostly everything which is driven by valuation, unrealized gains or losses of valuation, which are temporary. And if those gains are permanent, so let's say you have incurred a loss, but you are sure that it's not going to reverse out in near future, then you are allowed to book that as part of your profit and loss. But in case if something is expected to reverse out or in near future, are not allowed to be accounted. We will see a little bit more details on this in subsequent slides. And see, net profit adds up to retained earnings, and other comprehensive income adds up to accumulated other comprehensive income on balance sheet. So there are two separate lines presented on balance sheet, which is retained earnings and accumulated other comprehensive income. Both are part of your income statement, but because other comprehensive income, there is a possibility that those are temporary and may reverse out in future. Therefore, they are presented separately. So when we talk of comprehensive income is basically a sum of net income and other comprehensive income together. And what is accumulated other comprehensive income on balance sheet? So comprehensive income is an income statement item, whereas accumulated other comprehensive income is a balance sheet item. So it starts with your opening balance. There is a possibility that some of the accumulated other comprehensive income from opening balance may be reclassified to net income, because the temporary nature has now become permanent. So they will not be reclassified back to the other comprehensive. So those, once it becomes a permanent nature, then it will be reflected in net income. And there is current period other comprehensive income, which adds up to the ending other comprehensive income. Presentation requirements of other comprehensive income. So other comprehensive income is a balance sheet item. So it is presented as part of equity, but as a separate line item, separate component of equity. Changes in other comprehensive. In other comprehensive income, we have seen will change because there is a reclassification back to profit and loss account. There is an increase or decrease in other comprehensive depending upon your current period other comprehensive income. So, and other comprehensive income, because it is changing, it is part of your equity, it is also impacting, it's also changing the equity. So we have to present the other comprehensive income as part of statement of changes in equity. So as we have seen, as and when the other comprehensive income is realized, it moves into income statement. So these are the minimum captions of a P&L. We start with net sales or gross income. We have all the costs. Missing something here. Okay, one element of income statement, which I don't have it on my slide, is basically like income statement can be prepared either by function of expenses or by nature of expenses. Both are allowed, but preparing a income statement by function of expenses is recommended and encouraged. So what is the difference between function of expense and nature of expense? So let's say, for example, uh, salary is a nature of expense. But if that salary is related to factory workers, then that salary can be grouped as part of your cost of goods sales. It can be grouped as part of your manufacturing cost. So cost of goods sold is a function. So uh, factory expenses, and it can be grouped as part of your factory expenses. So let's say factory expenses is a function, but it can, that one line item can have multiple expense lines like salaries, it can have depreciation, it can have materials consumed, it can have repair and maintenance. So the challenge here is that if you prepare a financial statement as per function of expenses, you won't be able to uh, identify what is the individual cost line items. For example, what is the total salary, what is the total depreciation. So because depreciation again will be split across, for example, let's say we have selling expenses or marketing expenses. Selling expense is a line item which can have salary in it, it can have depreciation in it, which can have all the marketing or spends you are paying to third parties. It can have travel expenses in it, right? So when you say selling expenses on your P&L, which is prepared based on function of expenses, then you have to prepare a reconciliation in the notes to accounts back, explaining the nature of expenses of uh, each function. So we have to prepare present a breakdown of selling expenses. We have to prepare a breakdown, present a breakdown of cost of goods sold, what is included, or cost of goods manufactured, basically, or any other function that we are presenting. We can have, for example, marketing cost, or we can have HR cost as one function, HR as one function, or we can even have a finance function, right? All shared service can be one function. So all shared service can have a lot of different types of expenses. So, but that is permitted. I think I'm not sure if India accounting standard allows you to present a financial statement as per function of expenses. If any experts on this group can let me know. I think Schedule 3 of Companies Act require you to present your income statement as per nature of expense. It doesn't allow you to present your financial statement as per function of expenses. So this is one of the big difference between Ind AS and US GAAP, where US GAAP encourages and permits you to present your financial statement as per function of expense. So let me go back to Amazon. I would recommend, if you can open that Amazon financial statements on your respective laptops and see how they have presented. So let me try to share again if possible. Okay, I'm sharing it. Fine. If you look at the P&L of Amazon, so they have cost of sales, they have fulfillment, they have technology infrastructure, they have sales and marketing, general administrative. But do you see salary expenses here? The nature of expense is salary, but it's not presented. So salaries will be split across all these 5 lines or maybe 4 lines. We don't know. Do we see depreciation? We don't see depreciation. So probably depreciation is part of your fulfillment and technology and infrastructure. So this is the function, maybe based on the nature of business which Amazon is doing. Fulfillment can be a significant cost. Cost of sales could be the cost of direct materials that they are selling. It could be the cost of handling that material. It could be the cost of all the warehouse rents they are paying, all the depreciations of warehouse they have. So this somewhere in their financial statements or notes to account, they would have presented a breakdown of all the component of cost of sales. So after this session, probably whenever you have time, go through the Amazon financial statements on SEC and try to find out how they have presented a breakdown of cost of sales or fulfillment. This, or I mean, if you spot where exactly it is in notes to accounts, everything will be at one place. That entire reconciliation will be at one place. So you don't have to. Let me go back to my presentation. So having said that, I mean, while India accounting standard doesn't permit nature of function of expense, but US GAAP permits or allows you to use nature of expense. So if you have learned India accounting standard, you can always pitch in for US GAAP, even though if you don't know how to prepare your financial statement as per function of expense. And you really don't have to prepare it manually. Nowadays, softwares are there. You just need to configure your software so that the expenses are captured as per function of expense rather than nature of expense. So with that, yeah, minimum income. Okay, so statement of changes in stockholders' equity. So basically, this is a bridge of your opening stockholders' equity. Stockholders' equity is your all your equity share capital, all your retained earnings, all your accumulated other comprehensive income, and your additional paid-in capital, whether it is share premium, any buyback of share, and also preferred share in case if they are non-redeemable or redeemable at the option of the issuer, option of the company. If it is mandatorily redeemable preference share, those are not classified as equity, those are classified as debt. Another thing, I mean, we have a similar requirement, we have a similar thing in India accounting standard as well, but somewhere you will see that some of the terminologies is different. So what to do in case if you don't understand, just go back and Google. Let's say, for example, can you tell me what is treasury stock, right? When I was preparing this and I was not aware, so I just Googled and find out that this is a shares buyback. You have bought back the share which are not yet, what do you say, redeemed. So these are still holding, you are still holding in your balance sheet. So these are like treasury stock. These are called as treasury stock. So you're building a bridge between opening stockholder equity to closing stockholder equity broken down by each component. So common stock, your opening balance was 1,000. You have issued additional stock. Your share premium account was 5,000. You got additional premium. And then you have also issued so stock-based compensations, retained earnings. So this year you have declared dividends, so that is reducing your declared dividends. So accumulated other comprehensive income, you have a negative balance, and there is an additional OCI coming from your income statement, which is 200. Treasury stock, you can see you had initially 100, and this year they have again purchased another 300. So this is basically, and this is not a standard fixed format. You can choose how do you want to prepare, but make sure the content, we have enough content to explain the movement between opening balance to closing balance. And I think this is the best format which every organization is following. You can add more columns if you have more components. You can provide breakdown of AOC if in case if you have got significant items in AOC. So I think that's what is on cash flow. Again, like cash flow, both direct method and indirect methods are permitted. So you're free to choose what method you want to prepare. Some of the guidance, like basically interest paid, and basically, I mean, whenever you're presenting cash flow, you have to break down your cash flows into operating activities, investing activities, financing. The requirement is similar to what we have in Indian accounting standard. So these are not majorly different, but few guidance is like interest paid and received are classified as operating activities. Like for example, as per IFRS, interest received is not operating activity. It is financing activity. It is classified as well. So these are some small, tiny differences here and there. But otherwise, broadly, this is in line with what we see in IFRS or Ind AS. Notes to financial statements. I think this is where we need to spend a lot of time because if you see the financial statement, P&L, balance sheet, cash flow, each one of them is just one page, maximum 1.5 page, or if it is very elaborate, it is 2 page. But pick up any financial statements of any organization on SEC portal, you will see that notes to financial statements are running into 30 pages, 50 pages, sometimes 100 pages. So just imagine the content. So what is the purpose of notes to financial statements? Notes to financial statements, are also called as footnotes, generally used interchangeably, are integral part of your financial statement. So if you issue a financial statement without notes to financial statements, those will not be considered as a complete set. So notes to financial statement should always accompany financial statements. If we just issue P&L, income statement, cash flow without notes, it's incomplete. So purpose of notes to financial statements is to provide a narrative explanation, a breakdown or disaggregation, and a detailed information of the numbers given in the financial statements, right? And any additional information. So on the face of the financial statement, there isn't enough space to explain or provide the breakdown of the numbers. Let's say, for example, fixed assets. Fixed assets we have as one single line, but you have to provide a breakdown in notes to financial statement. The purpose of financial explain accounting policies, disclose the estimates and judgments, provide a detailed breakdown of financial line items, whatever we are presenting in financial. And we also have to disclose risk, uncertainties, and commitments. And the purpose is to enhance transparency and comparability. And some of the best practices is just to make sure it is clear, consistent, and the notes are cross-referenced back to the financial statements. Use plain language. Avoid boilerplate text. Basically, it means that don't copy paste from the standard US GAAP. So let's say, and the requirement is to have a tailored disclosure of accounting, which is specifically applicable or you have applied to your particular scenario into a particular organization in your particular financial statements. Just don't copy paste saying, okay, the accounting standard as it is on your. So when you're disclosing accounting policies, don't just copy paste the accounting standard here. Okay. So when we say explain accounting policies, so is it not enough that if we say that our financial statements are prepared in conformity with US GAAP? So why do we need to list down all the accounting policies? Basically, within US GAAP, we have got choices, we have got alternatives. For example, for inventory, we may adopt LIFO, we may adopt FIFO, we may adopt weighted average. For depreciations, we may have different methods of depreciation. Revenue recognition have got different approaches. Lease accounting has got different approaches. So what exactly we have chosen? Have we chosen LIFO for inventory or FIFO for inventory? So it is not enough if we just say we are preparing our financial statements in conformity with US GAAP, but rather we have to explain our choices, what we have chosen. And this we have to explain only for the significant accounting policies, not every tiny details. We have to just list on the accounting policies. And if you are applying an accounting policy for a particular year presented on the financial statement, we have to apply it consistently, and we have to apply it consistently year on year. So in case if there is a change, then that change has to be justified with explanation and the impact on financial statements. So this is the requirement. Generally, when you see notes to financial statement, this will be the first note you will see. What accounting policies have been used. This is a general requirement saying, okay, note one, but individual accounting standards have got a detailed disclosure requirements, a detailed breakdown or the requirements. So for example, revenue recognition requires that in our P&L, we present revenues as a single line item, but it requires that revenue to be broken down by product or maybe by segment or by, whatever is the composition. If you go back and see the financial statement of Amazon, you can see a detailed breakdown of revenues from different line of businesses. Similarly, we have got specific requirements by accounting standard 330, which is relevant to inventories. I think I'll share this slide with you. You can go through these details. This is still not an exhaustive list. This is just an sample. Okay, I'll cover two more slides and I will stop there. Pratisha, I know you are looking for. Okay, so I've got two more slides basically. So
Yes.
second
Given
disclosure.
we have, yeah. Just Naveen sir, given we have 15 minutes, maybe you can cover the critical points and maybe we can arrange, because a lot of people have been asking for the slides. So maybe the team, the backend team can arrange for circulating the slides to all the participants.
Yes. All right. So the next note or maybe note 2 of financial statement is just a statement saying that we have used estimates and judgments in accounting policies. Basically, there are a lot of areas: estimation of life of your asset, estimation of warranty claims, estimation of doubtful debts. So across across GAAP, there are various areas where we have used estimates and prepared our financial statements. And there are various judgments. When we choose LIFO over FIFO, we would have had some judgments. We would have had applied some judgment in choosing the accounting policies. So a organization is giving a statement that we have used the estimates, we have used the judgments which can go wrong, and the actual. So it's basically a disclaimer saying that we have used the estimates and judgments in specific areas and the actual results may be differing. So you can see, read here, the preparation of financial statement, conformity with US GAAP accounting principles, management to make estimates and assumptions that affect the reported amounts of assets, disclosure of contingent liability, various items we can list down, and the actual results could differ, but management is regularly evaluating the estimates and adjust the circumstances accordingly. The next requirement is the disclosure of risk and uncertainties. So basically, every business has a risk, inherent risks to their operations. I mean, there is no business which is risk free. So management is required to disclose the nature of their operations and the risk associated with their business. So for example, here we have got an example of a biotechnology firm which says that we are still a development stage companies and still we are not started generating commercial revenue. So it's a risk and they're massively dependent on investments. Similarly, we have seen the use of estimates in our previous slide. So, I mean, if you already given that disclosure on note 1, then we can actually skip this disclosure on use of estimates. And again, like certain significant estimates which can be highly subjective and volatile, we have to disclose them. Concentration risks. Few of the business have concentration risks. They may be operating in one particular geographies. Let's say, for example, businesses which were operating in Ukraine, they would have now been closed. So those, I mean, there could be possibility that you are dealing only with 1 or 2 customers. There is a risk that if the customer stop giving you business, you may go bankrupt or you may have to dissolve your business. There could be a possibility that you are massively dependent on technology. If something restricts you from use of the technology, maybe cost, maybe any other thing, then you can run out of the business. So those kind of risks management have to assess and disclose those as part of your notes to financial statements. Can you tell me is there such similar requirement in India? Do we have to disclose risks and uncertainties as part of our notes to accounts? So I'll leave you that as a homework. Probably you can check and find out. But for now, I'll pass it on to Pratyusha. I have another 1 or 2 slides, but I think we can skip that. Mostly we have covered majority or the most critical aspects of the US GAAP accounting. All right, Pratyusha, over to you. Thank you so much.
Thank you, sir. I think that presentation is very detailed. I think we have a lot of participants wanting to get the presentation, and
Yes.
I'm sure this 2-hour session is very small, very short for us for you to cover all this. And probably next time when we have a session on this, maybe we would request ICI to have a 3-hour session so that a lot of in-depth discussions which you wanted to share with us could happen. Sir, I think more or less we've been covering, questions simultaneously and broadly have categorized certain questions. But one question that people have been asking, more not from the technical point of view of US GAAP, but more from how do we get into this practice of US GAAP? Like probably there are certain fresher CAs who want to understand US GAAP, or even CAs who are into Indian GAAP. But there are questions like, is CPA compulsory for us to venture into prepare financial statements? So they wanted to understand from the career perspective of how US GAAP can be, how to transition into US GAAP.
Okay, so let me give you some business perspective of transitioning into US GAAP practice. Or I would not say US GAAP practice, but I would say US accounting. So GAAP is not mandatory. So we have seen there's not much of a difference. So even if you don't know US GAAP, still you can venture into getting business from US. Do we need to have CPA? I would recommend it strongly because CPA will give you a brand and a recognition. So if you approach in India, let's say, for example, a qualified chartered accountant and a unqualified accountant approaches for a business, who would stand a better choice. A qualified accountant will stand a better choices of getting the business. Similarly, if you go with a qualification which is recognized in US, like USA, then they will have a better trust in you, higher trust in your capabilities, and then there are chances that you may get opportunities there. Uh, how do you approach? How do you get the business? How do you get the client? Is again like first thing is that you should be able to do the job. Being a chartered accountant, you have learned income tax, you have learned India's, you have learned how to prepare. So similarly, you have to learn how to prepare your US GAAP financial statements, or understand the local statutory and regulatory environment in US. Understand. See, generally, what kind of business can we approach those large accelerated companies? They are already that segment is already saturated. So it's very, very difficult to penetrate. And that is already taken care by big fours and large outsourcing firms. So from my perspective, what I feel, if a solo practitioner or a small firm want to venture, this segment, small and medium enterprise segment, is still open. They are still dependent on local CPAs. So there is a possibility that, and we can approach them for outsourcing. Still, there is a cost arbitrage. There is a huge gap. For example, a chartered accountant preparing a financial statements for an Indian company, it's not auditing service, but preparing or finalizing the financial statements, how much they would pay? Maximum 1 lakh. But if you approach a US company, easily you can charge $10,000, which is about approximately 8.5 lakhs. The efforts are same. The efforts doesn't significantly differ. If you know how to prepare your financial statements, the efforts would be same for a higher price. So you always have a price arbitrage. You can leverage the pricing. Chances that you approach directly, and initial days there may be a challenge. People will not trust you, your capabilities, because US is again a highly regulated litigation environment. So people doesn't generally don't take chances of missing out or taking any risk of errors. So they just want to make sure that what you're doing is, so maybe initially that building that trust is difficult. So better to approach with the existing local CPA firms. They may not pay you as much as, but still you start venturing in, you can start supporting them, you learn the practical challenges, and over a period of time you'll gain confidence and you can start pitching in for your own business as well.
Right. Thank you, sir. I think I'm able to hear you very clearly, but I'm not sure if all the participants are able to, because there are certain complaints about video lagging. But okay, nevertheless, given that I'm able to hear you clearly, so I guess what you've said is very right, very true. Approaching the right way to approach, given that we already have a base of Indian GAAP which is very much strong, and also with the kind of exhaustive syllabus that CA in general has. So transitioning into US GAAP must not be really difficult. So
Absolutely no.
it is all about like the approach that we take for us, and the path that we take will probably make a difference. So with that, sir, given we have already reached the end of the session, so I will probably we can conclude this with closing remarks. One thing I would like to say is the session is very, very informative, and I'm sure we have almost active participants of 1,000 members joining the webinar, and yeah, it is very informative, and like the only complaint that I've got is probably the session could be longer, given that how involved you were in explaining to us, and particularly showing us how we can go to the Amazon, the SCC, taking us through our real life financial statements was very helpful and very elaborative for us to understand how actually in real life financial statements under US GAAP were being prepared. So thank you so much. Thank you so much for this exhaustive and very detailed session. Thank you for AI for organizing a session on US GAAP. And we hope that, we have multiple sessions on this, given the kind of interest that we are seeing from the participants. And my request to ICAI is to circulate the detailed presentation that participants are asking, because the backend team could support, given there is multiple interests and people have been requesting the presentations. And With that, I think we are good to close, sir. You have any closing remarks that you want to make?
Just want to say a big thanks to ICAI. You and Puneet, you approached me with this opportunity, for giving me this opportunity. I thoroughly enjoyed it. I wish it could have been a bit more interactive. So, but otherwise, it was a learning experience, learning journey for me as well. Thank you all so much. Reach out
Thank
to me
you.
in case if you have any questions. Probably, Pratyusha, I can share my contact details with you.
Sure, sure. Maybe I think in the circular, in the flyer, the webinar flyer that was shared, I think there were certain coordinates, but we can probably coordinate. I'll coordinate with the backend team to see how the participants can receive the information and how they can connect with us.
Sure.
Thank you so much. Then I think
Thank
we
you
are
all.
good to get close. Yeah, thank you. Have a nice day.
Thank you. Thank you. Bye bye.
Thank you.
Take care.